The housing market feels like it's in a constant state of flux, doesn't it? Especially when you zero in on mortgage rates.
Oh, absolutely.
It's this cycle of, small dips and then these forecasts that seem kind of stuck at these elevated levels.
Yeah.
And if you're thinking about buying a home right now, trying to make sense of it all, the rates, the Fed, the loan options, and the hidden costs, it can honestly feel like you're lost in a dense forest without a map.
It's true. There's so much information out there, and it's really easy to get caught up in just the headline rate,
Right.
But understanding the whole landscape, it really involves peeling back the layers. How the overall economy and the Fed influence rates, the specific requirements for different kinds of loans, and crucially, budgeting for all those expenses beyond just the down payment.
Absolutely. So our mission in this deep dive is kind of to act as your guides through that forest. We've pulled together a whole stack of sources, reports, and data from places like Freddie Mac, HSH.com, insights from financial news outlets like CNET, Bankrate, and detailed guides from experts like LendingTree and Rocket Mortgage. We're going to try and distill all of that into a clear, engaging, and most importantly, a practical guide for you to understand the current state of U.S. mortgage rates and, navigate the home buying process right now.
Yeah, we'll break down the latest on rates, try to demystify the Federal Reserve's indirect but honestly powerful influence. We'll explore the different loan programs out there and the key requirements and really put a big spotlight on those often surprising closing costs.
Yeah, those can bite you.
They really can. Our goal is to give you the knowledge you need to approach this whole process with, more confidence.
Okay, let's jump right in then with the most recent picture on rates, because there was actually a little piece of relatively good news in the latest data.
There was indeed. The most recent numbers released by Freddie Mac, this was for the week of June 5th, 2025, show that the average rate for a 30-year fixed-rate mortgage actually decreased slightly.
Oh, finally.
Yeah, for anyone who's been watching rates kind of inch up or just stay stubbornly high, any downward movement feels like, a breath of fresh air.
It does. A small victory for potential buyers this week. But, and this is where we kind of need to zoom out, the broader forecast from our sources keeps that optimism, maybe in check.
Precisely. While that weekly dip is certainly welcome, it doesn't necessarily signal a major shift in the overall trajectory. The CNET source, referencing Redfin's forecast, indicates that expectations are really for mortgage rates to remain near 6.8% for the rest of 2025.
6.8%. Oof.
Yeah. So that recent dip, it's likely just a small fluctuation within a broader, still pretty high rate environment.
And this is where the Federal Reserve enters the conversation, right? Everyone talks about the Fed, and there's this common assumption that if the Fed cuts its interest rate, mortgage rates will automatically just tumble. But that connection isn't quite as direct as many people think.
That's a critical point, and the CNET source clarifies this really well. The Federal Reserve doesn't set mortgage rates directly. Not at all.
Okay.
Mortgage rates are primarily influenced by conditions in the bond market, specifically the yield on the 10-year Treasury bond. What the Fed does is indirectly influence the broader cost of borrowing and the overall economic environment, which in turn impacts those bond yields.
How do they do that?
Their main tool is the federal funds rate, which affects very short-term borrowing between banks.
Okay, so they pull levers that influence the big picture economy, and then that ripple effect eventually reaches the bond market where mortgage rates kind of get their marching orders.
That's a good way to put it.
So given that they actually made some rate cuts back in 2024, why haven't we seen more significant downward movement in mortgage rates since then?
This is where the nuance is, fascinating. The Fed has been holding its key interest rate steady for a bit now, and the CNET source explains why. They're essentially waiting to fully measure the impact of broader economic policies before making further adjustments.
Broader policies like what?
Well, the source specifically mentions factors like existing tariffs, inflation, and the broader economy as elements the Fed is carefully monitoring before deciding on future rate actions. They're taking a cautious, kind of wait-and-see approach to gauge how these other policy levers are affecting economic activity and, importantly, inflation.
So it's not just about their own target rate. They're considering this whole complex web of economic forces before making their next move.
Exactly. And the market is watching this like a hawk. Financial markets, according to HSH.com via that CNET source, aren't anticipating any Fed interest rate cuts until September 2025 at the very earliest.
September. Wow, that feels like a long time to wait if you're, hoping for rates to drop significantly.
It does. And there's even a layer of uncertainty about September. The forces note that there's a real possibility of no cuts at all this year, if the economic conditions don't convincingly support them. Meaning inflation might not cool down sufficiently, or maybe other economic indicators just don't move in the direction the Fed needs to see to feel comfortable cutting.
And this is the crucial link back to your mortgage rate, right? What these market expectations about the Fed mean for bond yields.
Precisely. This is maybe one of the sharpest insights from our sources. The 30-year fixed mortgage rate is tightly correlated with the yield on the 10-year Treasury bond.
Okay, why the 10-year Treasury specifically?
Well, think about it. Mortgages are long-term loans. And the investors who buy mortgage-backed securities, which are essentially just bundles of mortgages, they're looking for a return on their investment over a long period, right? Similar to investors in the 10-year Treasury, they're basically competing for the same investment dollars.
Ah, okay. So if Treasury yields are attractive,
then mortgage rates need to be competitive to attract that same money.
got it. They're competing for the same pool of long-term investment capital.
Yes. Now, when financial markets anticipate fewer Fed rate cuts, or maybe no cuts at all, this signals to investors that short-term interest rates are likely to stay higher for longer.
Right.
And that generally puts upward pressure on longer-term yields like the 10-year Treasury. Why? Because investors demand a higher return for locking up their money for a longer period when short-term rates are elevated.
Makes sense.
Then you add this other factors like potential increases in government debt, which increases the supply of Treasury bonds needing to be bought, and you create an environment that just naturally pushes those yields higher.
So let me get this straight. The market's expectation of the Fed holding steady, plus other factors affecting bond supply and demand, translates directly into higher yields on the 10-year Treasury.
And therefore, higher rates for your mortgage. That's the chain reaction. The expectation of fewer rate cuts, maybe concerns about deficits, keeps upward pressure on the bond market, and since mortgage rates track those bonds, they stay elevated, consistent with that 6.8% forecast for the rest of the year we mentioned.
Wow. That really helps connect the macroeconomic policy dots all the way down to the number you actually see on a mortgage quote. It's not the Fed setting the rate directly, but the market reacting to the Fed and other factors that influence the bond yields, which then dictate the mortgage rate.
Understanding that indirect link is really key to having realistic expectations about where rates are headed, or maybe not headed in the near future.
Okay, so that gives us a pretty solid handle on the interest rate itself and the big picture influences. Now let's pivot to the practical side for someone actually embarking on the home buying journey. Because even if you understand the rate, getting a mortgage isn't exactly a one-size-fits-all proposition, is it?
Not at all.
There are different doors to walk through depending on who you are and your financial situation.
Exactly. You really need to understand the different loan programs available, because the right one for you depends entirely on your personal circumstances. The Lending Tree source does a good job laying out the main categories that most home buyers are going to encounter.
And those are the big ones: conventional loan, FHA loan, VA loan, and USDA loan.
Correct. Think of these as like the 4 major pathways to homeownership. Each one has its own set of eligibility rules, and they're designed to serve different needs and different borrower profiles.
And while they have distinct features, there are some universal requirements you'll probably face, regardless of which path you choose, right? What are the fundamental criteria lenders are always looking at?
Across the board, lenders are primarily focused on your ability to repay the loan. That's the bottom line. And this usually boils down to 3 key areas: your down payment, your credit score, and your debt-to-income ratio, or DTI.
Okay, the big 3. Let's look at those minimums because they vary quite a bit by program based on that Lending Tree table. For a standard conventional loan, what are the typical benchmarks we're talking about?
For a conventional loan that's one not backed by a government agency, the minimum requirements are generally a 3% down payment, a minimum credit score of 620, and a maximum debt-to-income ratio of 45%.
And just quickly, DTI is?
Right, DTI is your total monthly debt payments, think student loans, car payments, credit cards, plus the proposed mortgage payment divided by your gross monthly income, so your income before taxes.
Okay, so 3% down, 620 credit, 45% DTI for conventional. How about the FHA loan? This one is often seen as more accessible for folks with maybe lower credit scores or less cash up front.
Yeah, the FHA loan, which is backed by the Federal Housing Administration, is designed for just that purpose. The minimum down payment is 3.5% if your credit score is 580 or higher.
Okay.
Now, if your score is a bit lower, say between 500 and 579, the minimum down payment actually increases to 10%.
Oh, interesting.
Yeah. And the standard DTI limit is 43% though there can be exceptions, sometimes up to around 50% in certain cases,
Yeah.
especially if you have what they call compensating factors.
So FHA opens the door for credit scores below that conventional minimum, but you might need a higher down payment if your score is in that lower range. Got it. What about VA loans, a fantastic benefit for our military members and veterans?
Oh, absolutely. The VA loan, guaranteed by the Department of Veterans Affairs, is really notable for its potential zero down payment requirement for eligible borrowers with full entitlement. That's a huge advantage.
Huge.
Now, while the VA itself doesn't set a minimum credit score, the lenders issuing VA loans typically require a minimum score of 620. The standard DTI limit is 41%, but the VA also uses something called the residual income calculation, which can sometimes allow for approval even with a higher DTI if you have enough income left over after paying all your major bills.
Zero down is certainly attractive. Okay, and finally, the USDA loan aimed at rural and suburban areas.
Right, the USDA loan, guaranteed by the U.S. Department of Agriculture, also offers a zero down payment option. This is for eligible low to moderate income borrowers buying in USDA-designated rural or suburban areas. You actually have to check the USDA's online eligibility maps for specific property locations.
Okay.
Similar to VA loans, the USDA itself doesn't have a minimum credit score, but lenders typically look for a score of 640 or higher. The standard DTI limit is 41%. Again, with possible exceptions, up to maybe 44% if you have strong compensating factors like good credit or cash reserves.
That table really highlights the different entry points these programs provide based on those three key factors: how much cash you have for a down payment, your credit history, and your existing debt load relative to your income.
Absolutely.
Yeah.
And it's so vital to remember, as the sources emphasize, that these are minimums. Just meeting the minimum doesn't guarantee you the best rate or terms, not by a long shot.
Right. Better terms require better numbers.
Exactly. Having a higher down payment, ideally 20%, for conventional to avoid mortgage insurance, a significantly stronger credit score, north of 740, maybe even 780 plus for the premium rates, and a lower DTI ratio will make you a much more attractive borrower. And that likely results in a lower interest rate and overall better loan terms.
Speaking of money needed up front, most people understandably fixate on the down payment amount. But our sources repeatedly highlight another significant and often underestimated cost that first-time buyers in particular can be surprised by: closing costs.
This is such a crucial point, and the Rocket Mortgage source really hammers it home. Closing costs are a major expense paid on closing day, and they're completely separate from your down payment. If you're budgeting for a home, you must factor these in, seriously.
So what exactly are these closing costs covering? It sounds like a catch-all term.
It kind of is. They are essentially fees paid to various third parties involved in the loan transaction and the transfer of property ownership. This includes fees for things like the appraisal, title searches, legal services if they're applicable in your state, loan origination and processing by the lender, and potentially funding an escrow account for future property taxes and insurance.
Okay, and the amount. This is the scary part. How much should someone realistically budget for closing costs?
This is where the surprise can really hit. Closing costs typically range from 3% to 6% of the loan amount, not the home price.
Okay, the loan amount. That's an important distinction.
It is, because
Okay.
the percentage applies to the amount you are borrowing, not the full purchase price of the house.
Okay, let's put that into perspective then. If someone is taking out, say, a $200,000 mortgage loan, what kind of dollar amount are we talking about for closing costs?
On a $200,000 loan, applying that 3% to 6% range means you could be looking at closing costs anywhere from $6,000 on the low end to $12,000, or maybe even a bit more on the high end.
Wow, $6,000 to $12,000.
Yeah. And that cash has to be ready at closing, in addition to your down payment. It's a substantial sum of money.
That's a significant second bucket of cash needed right there at the finish line. Okay, let's break down some of the comment line items you'd see on that closing disclosure form. The Rocket Mortgage source lists several key ones. What's the appraisal fee for?
Right. The appraisal fee pays for a professional appraisal of the home's market value. The lender requires this to make sure the property is actually worth at least the amount you're borrowing. This protects them, obviously, but it also protects you from potentially overpaying significantly.
How much does that usually run?
The source gives a typical range of maybe $300 to $600 for this fee, but it can definitely vary based on the property's complexity and where it's located.
Okay. Then there's often a loan origination fee. What's that covering?
That's basically the lender's fee for doing the work, processing, underwriting, and preparing your loan. It covers their administrative costs. This fee is commonly calculated as a percentage of the loan amount, often around 1%.
So on our $200,000 loan example, That could be another $2,000 right there.
Easily.
Okay. What about title search and title insurance? This sounds important, like verifying ownership.
Exactly. A title search is done to check the public records, confirming the seller legally owns the property, and that there are no outstanding limites, judgments, or other claims against it that could mess up your ownership later.
How much is the search?
The search itself might cost $75 to over $200. Then title insurance comes in two flavors. Lender's title insurance, which is almost always required, and protects the lender if a title issue pops up after closing. And then there's owner's title insurance, which is technically optional but highly recommended, as it protects you, the buyer.
And the cost for the insurance part?
Cost for title insurance can vary, often falling somewhere between maybe 0.5% and 1% of the loan amount for the lender's policy or the purchase price for the owner's policy.
Okay, so protecting the lender and ideally yourself from potential ownership problems down the road. We mentioned mortgage insurance earlier when discussing loan types. How does that factor into closing costs? Is it paid up front?
Sometimes. If you're getting a conventional loan with less than 20% down, you'll pay private mortgage insurance, or PMI. While it's often paid monthly with your mortgage payment, some lenders might give you the option to pay some or all of it upfront at closing, or maybe combine an upfront payment with a reduced monthly premium.
Okay.
For government loans, it's a bit different. FHA loans have that upfront mortgage insurance premium, the UFIP, which is 1.75% of the base loan amount. It's typically paid at closing and usually financed right into the loan. VA loans have a VA funding fee instead of mortgage insurance, ranging from 2.15% to 3.30% of the loan amount, also typically financed. And USDA loans have an upfront guarantee fee of 1%, again, usually financed.
So these upfront fees are a direct closing cost tied to putting down less than 20% or using one of those government programs.
Correct. That insurance cost, whether PMI or the government fees, shows up either as an upfront fee at closing, or it's rolled into your monthly payment, or sometimes both, depending on the structure.
Right, and it's important to remember the difference in how long they last, right?
Absolutely. Conventional PMI can often be canceled once you reach 20% equity based on the original value, or sometimes sooner if the value increases. But FHA's annual MIP, that generally lasts for the life of the loan unless you put down 10% or more initially. That's a big difference. VA and USDA fees are primarily upfront or annual, not quite like the monthly PMI or FHA annual MIP.
You also mentioned funding an escrow account for prepaid items. What does that involve at closing?
Right. Lenders often require you to prepay certain expenses at closing to fund an escrow account. This account is basically where money is held to cover your future bills for property taxes and homeowners insurance.
So you pay ahead.
Yeah, you'll typically need to pay a full year's worth of your homeowner's insurance premium up front. The source estimates maybe around $50 per month for every $100,000 of home value for insurance. So on a $200,000 home, that's maybe $1,200 for the annual premium. Plus, you might need to put a couple of extra months' worth into the escrow account to start it off.
And property taxes.
Property taxes vary wildly by location, so that part of the escrow funding can be much larger depending on where you're buying. High tax areas mean more upfront for escrow.
So you're not just paying for the current costs at closing, but also funding this buffer for future bills that the lender will then pay on your behalf. Okay. Are there any other miscellaneous fees that might pop up?
Oh, yeah. Depending on your location and the specifics of the deal, you might see things like attorney fees if they're required in your state, transfer taxes paid to the local government for transferring the deed, maybe a pest inspection fee if the lender or contract requires it, or sometimes even a fee to lock in your interest rate, though many lenders offer a certain rate lock period for free. Plus, you might have small things like courier fees, recording fees for the deed, and mortgage, stuff like that.
It sounds like the list can get quite long, and the total really varies.
It does. The Rocket Mortgage source points out that closing costs vary significantly by state. Local taxes, required services, regulations, they all play a role. So while that 3% to 6% is a decent general guideline, the actual amount can definitely be higher or lower depending on where you're buying.
Who typically pays these costs? Is it always the buyer footing the whole bill?
Not necessarily. Both the buyer and the seller incur various costs in a real estate transaction. And here's a potentially powerful insight for buyers. Closing costs are often a negotiable area.
Really?
Yes. Especially in maybe a slower market, or if the seller is highly motivated, you can often ask the seller to contribute towards your closing costs. These are called seller concessions.
Seller concessions. Okay, so basically asking the seller to pay some of your fees. Are there limits on how much they can contribute?
Yes, absolutely. There are strict limits set by the different loan programs, mainly to prevent fraud or artificially inflating the sale price. For conventional loans, for example, the limit on seller concessions is typically 3% of the sales price or appraised value, whichever's lower. If your down payment is less than 10%, it goes up to 6% if your down payment is 24.99%, and 9% if you put down 25% or more.
And government loans.
Government loans like FHA, VA, and UFDA often have different limits, sometimes a bit more generous, but limits still exist. So using our $200,000 loan example again, let's say you put 5% down on a $210,526 home, the seller could potentially contribute up to 3% of that price, which is roughly $6,350 towards your closing costs.
That's a significant amount. That could potentially cut your needed cash at closing nearly in half in that 6K, 12K range. It sounds like asking for seller concessions is something buyers should definitely explore.
Absolutely. It's a key area for negotiation, especially if you're trying to minimize your upfront cash requirement beyond the down payment itself.
Cool.
Just be aware of the specific program limits for the loan you're getting.
So you've applied for the loan, you're working through this whole process. When do you actually see the final official lists of all these closing costs you'll owe, like the real numbers?
The lender is required by federal law to provide you with a standardized document called the closing disclosure at least 3 business days before your scheduled closing date.
Okay, 3 days before.
Yes. This document clearly lists every single fee, who is paying it, you or the seller, and the exact amount. This gives you time to review it carefully, compare to the initial loan estimate you received, and ask your lender questions before you actually sign on the dotted line.
And how long does this whole process usually take from applying to getting that disclosure and closing?
The source says the entire process, from initial loan application to getting that closing disclosure and finally closing, typically averages between 30 and 45 days, sometimes longer if there are complications.
Okay. And last question on costs. Is there ever an option to roll these closing costs into the loan amount itself to avoid paying them out of pocket?
Sometimes, yes. It depends on the lender and the specific loan program. It's often marketed as a no closing cost mortgage, but let's be clear, the costs don't just disappear.
Right, there's no free lunch.
Exactly. What's usually happening is the closing costs are being financed, added into your total loan balance, or the lender is charging you a slightly higher interest rate over the life of the loan to cover those costs internally.
And the trade-off there.
The Rocket Mortgage source points out the obvious trade-off. While this reduces the cash you need right at closing, which can be helpful, you end up paying interest on those closing costs over the entire life of the loan. This increases your monthly payment slightly and means you pay significantly more in total over time.
So yeah, closing costs are substantial. 3% to 6% of the loan amount is a good rule of thumb. They cover everything from appraisal and title fees to mortgage insurance and prepaid taxes and insurance. Budgeting for this, understanding the fees, knowing you might be able to negotiate some seller help, these are crucial parts of preparing to buy a home.
It's definitely more complex than just saving up the down payment, that's for sure.
Okay, we've covered the high-level rates and the big cost picture. Now let's circle back and dive a bit deeper into those specific loan programs we mentioned, conventional, FHA, VA, and USDA. Let's explore some of the nuances and maybe special features of each, because this is really where the best fit for your specific situation becomes clearer.
Sounds good. Let's start with the conventional loan again, since it's the most common type. We know the base requirements. Minimum 3% down, 620 credit score, 45% DTI limit.
Right. And a key factor for conventional loans with less than 20% down is that private mortgage insurance, or PMI. Tell us a bit more about how that works and when you pay it.
Okay, PMI. It protects the lender, not you, if you default on the loan when you have less than 20% equity. As the lending tree source explains, you typically pay it as a monthly premium, just added right onto your mortgage payment.
And the cost varies.
Yes. The cost of PMI varies based on your credit score and your down payment amount. Generally, a higher score and a larger down payment mean lower PMI premiums. And as we touched on, you can sometimes ask your lender about options to pay some or all of the PMI upfront at closing to reduce or eliminate the monthly payment.
And the best part about conventional PMI is that it doesn't last forever, usually.
That's a huge advantage, yes.
Yeah.
Unlike FHA's mortgage insurance, conventional PMI is cancelable. Lenders are required by law to automatically cancel PMI once your loan balance is scheduled to reach 78% of the original home value. But you can also request cancellation earlier generally once your equity reaches 20% of the original value.
Or if the home value goes up.
Right, potentially. If you make significant improvements that increase the home's value, and your loan balance is 80% or less of the new appraised value, you might be able to request cancellation then too, though this usually requires getting a new appraisal at your expense.
That ability to eventually get rid of PMI once you build equity is a significant plus for conventional loans compared to FHA for many buyers.
Okay, you mentioned the credit score minimum of 620. The source also brought up something interesting about how that's calculated for joint applicants. It's average median credit scoring thing.
Yes, this can be helpful for borrowers applying together, like a married couple. Some lenders might use average median scoring. They pull credit reports for both applicants, find the median score for each person, that's the middle score if you have 3 reports, or the lower of 2 if you only have 2 scores reported, and then they might use the average of those median scores. However, for standard conventional loans through Fannie Mae and Freddie Mac, they typically just use the lower of the 2 applicants' median scores for qualification purposes.
So the lower score drives the bus. Often, yes, especially for determining the interest rate. The key takeaway, though, is that even if one applicant has a score just above the minimum, a co-applicant with a much stronger score can definitely help the overall application strength and potentially get it approved, even if the rate is based on that lower qualifying score. Better scores for all borrowers always mean better rates, though.
Makes sense. And what about verifying income for conventional loans? What do they need to see?
Lenders absolutely need proof of stable income to make sure you can actually make the payments. For regular W-2 employees, this usually means providing pay stubs for the most recent 30 days and your W-2 forms for the past 2 years.
And if you're self-employed or have commission income,
then the requirements get stricter. Fannie Mae and Freddie Mac generally require 2 full years of personal and business federal income tax returns to properly calculate your qualifying income. Some lenders might make exceptions, maybe allow just 1 year of self-employment income if you have a strong track record in the same field, but 2 years is really the standard. They'll scrutinize fluctuating income or recent job changes much more closely.
Okay. Are there also cash reserve requirements for conventional loans, money left over after closing?
Yes, this is another factor that's not always highlighted up front, but is important. Lenders typically require borrowers to have a certain amount of cash reserves after closing, meaning funds left in your bank account that are easily accessible, not tied up. The requirement varies quite a bit based on factors like your credit score, your DTI, your down payment amount, and whether you own other properties. It could range from 0 months of reserves needed for a really strong borrower buying their primary residence, up to 6 months or even more of your total monthly mortgage payment, PITI, principal, interest, taxes, insurance, for borrowers with lower scores, higher DTI, or especially those buying second homes or investment properties.
So beyond the down payment and closing costs, you need to show you still have funds set aside for, unexpected expenses or a buffer.
Okay.
You also mentioned earlier some specific conventional programs designed to help maybe lower income borrowers.
Yes. Fannie Mae's Home Ready and Freddie Mac's Home Possible programs are great examples. They're conventional loans, so they follow many of the standard rules, but they're specifically designed for borrowers with lower to moderate incomes who might struggle with the standard down payment or maybe even some credit requirement.
What makes them different?
The key feature is the lower minimum down payment, just 3%. However, they do have income limits. Generally, your income cannot exceed 100% of the area median income, or AMI, for the specific location where you're buying. You have to check the limits for your area.
And these programs offer some other flexibilities too.
They do, which is really part of their appeal for eligible borrowers. The Lending Tree source notes, they can be more flexible with income and credit verification sometimes. For instance, if you have limited traditional credit history, they might allow the use of alternative credit data, things like proof of paying rent on time or utility bill payments to help establish your creditworthiness.
That's helpful.
Yeah, and they also allow consideration of border income. That's rent paid by a long-term roommate who has lived with you for at least a year, which can help boost your qualifying income. Income from vested restricted stock units, RSUs, can often be used. And in some cases, even sweat equity, the value of your own labor if you're buying a fixer-upper and doing some of the renovations yourself, can sometimes be counted towards your down payment or closing costs.
Border income, sweat equity. Those are definitely creative ways to help make homeownership possible for folks with maybe less traditional financial profiles. What about that Refino program you mentioned?
Right, Refinow is a specific Fannie Mae program, But it's not for buying a home. It's aimed at helping existing homeowners refinance an existing Fannie Mae-owned mortgage. It's designed for people who might have limited equity or maybe a higher DTI that prevents them from qualifying for a standard refinance.
So easier refi criteria.
Yes, it has similar income limits up to 100% of AMI, but it's much more flexible on DTI, allowing up to 65%. And interestingly, it has no minimum credit score requirement if you meet the income limit and have at least 3% equity in your home. It's a very targeted program just to help eligible homeowners lower their interest rate and monthly payment.
Okay, that covers the conventional world pretty well, including some helpful pathways for those with less traditional finances. Let's move on to FHA loans now, known for being more accessible, particularly on the credit score side.
That's really their primary advantage. Since the Federal Housing Administration, the FHA, insures the loan against default, lenders are generally more willing to take on borrowers with lower credit scores than they would for a conventional loan.
And we touched on the down payment tiers based on credit score earlier.
Right. 3.5% down for scores of 580 or higher, and 10% down if your score is between 500 and 579. This really opens the door for many people who might not meet that 620 conventional minimum.
And they have those two types of mortgage insurance, the upfront premium UFMIP and the annual MIP.
Correct. The upfront mortgage insurance premium, UFMIP, is a one-time fee equal to 1.75% of the base loan amount. It's typically paid at closing and almost always just financed into the loan, which increases your loan balance slightly. Then there's the annual MIP, which is calculated as a percentage of the loan balance each year and paid in 12 monthly installments as part of your regular mortgage payment.
And the annual rate.
The annual MIP rate varies slightly based on your loan amount, the loan term, and your LTV loan-to-value ratio, but it typically ranges from 0.45% to 0.85% per year.
And the critical point about the annual MIP is how long it lasts.
Yes, this is crucial. Unlike conventional PMI, FHA's annual MIP generally remains for the entire life of the loan, regardless of how much equity you build up, unless you made a down payment of 10% or more initially. If you put in 10% or more, it can be canceled after 11 years. But for most FHA borrowers putting down 3.5%, that MIP is permanent. It's a significant ongoing cost compared to cancelable conventional PMI.
That's a really important trade-off to understand. What about the DTI limit for FHA? Is it tighter than conventional?
The standard maximum DTI for FHA is 43%. So yes, that's a bit tighter than the 45% conventional limit on paper. However, FHA underwriting tends to be generally more flexible in considering those compensating factors we mentioned. Things like significant cash reserves, excellent credit history despite a lower score, or a very stable job might allow a borrower to qualify with a DTI slightly higher than 43%, sometimes up towards 50% in strong cases. The source mentioned potential exceptions up to 45% DTI, specifically for energy-efficient homes, as one example.
Okay. Are there property restrictions or usage rules for FHA loans? Can you buy an investment property?
No, FHA loans are strictly for purchasing a primary residence, a home that you intend to live in full-time. You cannot use an FHA loan to buy a second home or a pure investment property.
But you can buy multi-unit properties?
Yes, you can use them for 1 to 4 unit properties, like a duplex or triplex, approved condos, and some manufactured homes, as long as you plan to live in one of the units as your primary residence.
And the appraisal process is known for being quite specific, maybe stricter.
It is. FHA appraisals are conducted by FHA-approved appraisers, and they have to follow specific guidelines called Minimum Property Standards, or MPS. These standards are really focused on ensuring the home is safe, sound, and sanitary.
What kind of things are they looking for?
Appraisers are looking for things like functioning plumbing and electrical systems, a secure roof without leaks, absence of safety hazards like peeling paint in older homes, potential lead paint issue, adequate heating, things like that. If the appraisal notes required repairs to meet these MPS, those repairs absolutely must be completed before the loan can close. It's a process designed to protect both the borrower and the FHA insurance fund by ensuring the property is habitable and structurally sound.
Okay, good to know. Moving on to VA loans, the real powerhouse for eligible military members and veterans. That 0% down payment and no monthly mortgage insurance are huge advantages.
They truly are significant benefits earned through service. For eligible borrowers who have their full VA entitlement, putting 0 down is standard. And you're right, instead of monthly mortgage insurance like PMI or FHA MIP, VA loans have that one-time VA funding fee.
And the amount varies.
Yes. The amount varies based on your branch of service, whether it's your first time using a VA loan or a subsequent use, and how much you put down, if anything. For a first-time user putting 0 down, the fee is currently 2.15% of the loan amount. For subsequent users putting zero down, it jumps to 3.30%. It's lower if you do put some money down. And this fee is almost always just financed right into the loan amount.
Okay. And credit score. We said the VA doesn't set a minimum, but lenders usually do.
Correct. The Department of Veterans Affairs itself does not mandate a minimum credit score. But because private lenders are the ones actually originating these VA-guaranteed loans, they set their own internal requirements or overlays. The most common minimum credit score required by VA-approved lenders is typically 620, though you might find some who require higher.
What's the standard DTI limit for VA loans?
The VA generally recommends a maximum DTI ratio of 41%. However, VA underwriting is quite unique because it places a really strong emphasis on something called residual income.
Residual income.
Yeah, residual income is the amount of net income you have remaining each month after deducting all your major monthly expenses. That includes the proposed housing payment, all other debts, estimated utilities, income taxes, and basic living costs based on your family size and geographic location. If a borrower has sufficient residual income according to VA guidelines, they might actually be approved even if their DTI technically exceeds that 41% benchmark.
Interesting. So they look beyond just the ratio to see if you actually have enough buffer for living expenses each month. Are VA loans also limited to primary residences?
Yes. Just like FHA, VA loans are strictly for financing a primary residence that the veteran or eligible surviving spouse will occupy. You cannot use a VA loan for a second home or a pure investment property. Also, like FHA, you can use them for eligible 1 to 4 unit properties and approved condos, provided you live in one of the units.
And the VA appraisal process also specific?
It is. VA loans require a VA appraisal, which results in a document called a Certificate of Reasonable Value, or CRV. It has to be performed by a VA-approved appraiser. The appraiser determines the market value, of course, but also checks that the property meets the VA's minimum property requirements, or MPRs.
Similar to FHA's standards.
Similar in concept to FHA's MPS, yes, focusing on safety, structural soundness, and sanitation, but with some specific VA differences. And unlike conventional loans, where appraisal waivers are sometimes possible based on automated underwriting findings, appraisal waivers are generally not permitted for VA purchase loans. You need that VA appraisal.
Okay. Finally, let's talk USDA loans focused on those rural areas. The 0% down payment is a major feature here, too.
Yes, the USDA Single-Family Housing Guaranteed Loan Program, that's the full name, is another excellent 0% down option for eligible borrowers. The key restriction, as you said, is geography. The property must be located in an area designated as rural or suburban by the USDA. They have online eligibility maps you can use to check any specific address. It's surprising how many suburban areas actually qualify.
And it's for lower income borrowers specifically.
Yes. Unlike VA or standard conventional loans, USDA loans are specifically targeted towards low to moderate income borrowers.
You mentioned guarantee fees instead of mortgage insurance for USDA.
Correct. Similar structure to VA in that sense. There are 2 fees. An upfront guarantee fee equal to 1% of the loan amount, which is typically financed into the loan. And then there's an annual guarantee fee, which is equal to 0.35% of the remaining loan balance each year. And that's paid in monthly installments along with your mortgage payment.
Okay. What about credit scores and, importantly, those income limits for USDA loans? This is where it gets a bit more specific, right?
It does. The USDA itself doesn't publish a minimum credit score requirement. However, lenders typically require a score of 640 or higher to use the USDA's automated underwriting system called GUS, Guaranteed Underwriting System, which allows for a more streamlined approval. If your score is lower than 640, manual underwriting might be possible, but it's definitely more complex and less certain.
And the income limits, how did those work?
This is crucial for USDA. USDA loans have strict income limits, and they calculate income differently than other programs. They look at the total household income. That includes the income of all adult members of the household, typically anyone age 18 and older, whether they are actually on the loan application or not.
Wow, everyone living there.
Generally, yes.
Yeah.
This total household income cannot exceed 115% of the area median income, AMI, for the county or metropolitan area where the property is located. This means even if you, the borrower applying for the loan, meet the income requirements on your own, if you live with other adults whose income pushes the total household income over that 115% limit, you may not qualify for the USDA loan.
That's a very important detail. Total household income, not just borrower income, matters for USDA. And the DTI limit.
The standard DTI limit is 41%, same as VA on paper, meaning your total monthly debt payments, including the proposed mortgage, shouldn't exceed 41% of your gross monthly income. Like VA, there could be some flexibility here too, with potential exceptions allowing a DTI up to maybe 44% if you have strong compensating factors. USDA looks for things like a credit score of 680 or higher, significant cash reserves after closing, or a very stable employment history to justify going above 41%.
Any other property or restrictions for USDA besides just being in an eligible rural or suburban area?
Yes, the lending tree source notes some property type restrictions as well. The home must generally be a single-family dwelling intended for primary residence. There can sometimes be limitations on the maximum square footage, often capped around 2,000 SQF, although this can vary, with a general minimum guideline maybe around 400 SQF. And importantly, the property cannot have features typically associated with income-producing activities, like excessive acreage designed for farming or large outbuildings, clearly set up for a business, unless those features are common for residential properties in that specific area and don't interfere with the home's primary use as a residence. So, comparing these programs side by side, you really see how they try to serve different segments of the market. Conventional for those meeting standard requirements, FHA for more credit flexibility, VA offering incredible benefits for military service, and USDA focusing on rural areas and moderate incomes. Understanding the specifics of each regarding down payment, credit, DTI, the mortgage insurance or fee structure, income rules, and property types is absolutely key to finding your best fit.
It's really clear that digging into the details of these programs is essential. And just quickly, for listeners who might be considering properties beyond a standard single-family primary residence, like maybe a vacation home, a rental property, or even trying that house hacking strategy by buying a multi-unit, our sources touch on how the requirements change there, too.
Right. If you're looking at a second home or investment property, your financing options narrow pretty significantly. As we discussed, FHA, VA, and USDA loans are strictly limited to primary residences that you will personally live in. So for second homes and investment properties, you'll almost always need a conventional loan.
And the requirements are usually more stringent for those non-primary residence loans.
Generally, yes. Lenders definitely perceive financing a non-primary residence as carrying higher risk. For a second home, you're typically looking at a minimum down payment of 10%, though needing 20% or more is quite common to get better terms. The property usually must be a single-unit home, intended for your seasonal or recreational use, located at a reasonable distance from your primary home, and crucially, it cannot primarily be used as a rental property generating income.
Okay. And for a pure investment property, like a home you buy solely to rent out to tenants?
Requirements get stricter still. You'll commonly need a minimum down payment of 20% and sometimes as high as 25% or even more, especially if you're buying multi-unit investment properties. Lenders will absolutely require proof of potential rental income, often using an appraisal that includes a market rent analysis to help you qualify, but they typically only count about 75% of that projected rent towards your qualifying income.
Only 75%?
Yeah, they build in a vacancy factor. And you also often need significant cash reserves after closing, sometimes up to 6 months of mortgage payments per property if you already own multiple rentals. Credit score requirements are also usually higher than for primary residences.
Wow, okay. What about that house hacking idea? Buying a multi-unit property, like a duplex, triplex, or fourplex, and living in one unit while renting out the others. This seems like a strategy people use to make homeownership more affordable.
This is where it gets really interesting because you can potentially use those government-backed loans for house hacking, which offers much lower down payment options compared to conventional financing for multi-units.
How so?
If you plan to occupy one unit of a 2 to 4 unit property as your primary residence, you can potentially use an FHA loan with its standard 3.5% down payment, or, if you're eligible, a VA loan with 0% down.
0 down on a fourplex.
If you're VA eligible and live in one unit, potentially yes.
That's amazing. And FHA allows you to use the potential rental income from the other units to help qualify, right?
Yes. That's a huge benefit for house hacking with an FHA loan. They allow you to factor in a portion, usually 75%, again accounting for vacancy of the projected rental income from the non-occupied units into your qualifying income. This can significantly boost your borrowing power and really help you meet the DTI requirement, especially if you're a first-time buyer trying to afford a multi-unit.
Is there a catch?
Well, one specific FHA requirement is that borrowers buying 2 to 4 unit properties generally need to have 6 months of PITI payments in cash reserves after closing, which is higher than for a single unit FHA purchase. Conventional loans can also be used for multi-unit house hacking, of course, but typically require a higher down payment than FHA or VA, often starting at 5% down for a duplex and potentially going up to 25% for a fourplex, and might have higher credit score requirements as well. So yeah, depending on exactly how you plan to use the property as your primary home, a vacation spot, a pure rental business, or a house hack, the available loan programs and their specific requirements change quite dramatically.
That gives you a much clearer picture of the different paths and complexities based on your property goals. Okay, stepping back from the specific loan types for a moment, once you've kind of narrowed down the program possibilities, you face another really fundamental structural decision. Choosing between a fixed-rate mortgage versus an adjustable rate mortgage. The bank rate source provides some excellent guidance here.
Yeah, this is a core decision, and it really comes down to your personal risk tolerance and, crucially, how long you realistically plan to stay in the home. The fundamental difference, as the source lays out clearly, is simply how the interest rate behaves over the life of the loan.
Okay, with a fixed-rate mortgage, or FRM, it sounds like the definition is pretty much in the name.
Exactly. With a fixed-rate mortgage, your interest rate is set when you close on the loan, and it remains the same for the entire term of the loan, which is typically 15 or 30 years. This means the principal and interest, the P&I portion of your monthly payment, never ever changes.
Never changes. Okay.
Now, your total monthly payment, which usually includes escrow for property taxes and homeowners insurance and maybe HOA fees, that could still change over time if your taxes or insurance costs go up or down. But the core P&I component is absolutely fixed, predictable.
And an adjustable rate mortgage, or ARM, is different how?
An ARM starts out with an interest rate that is fixed, but only for an initial introductory period. This period is commonly 3, 5, 7, or 10 years. You often see these referred to as hybrid ARMs, like a 51 ARM. That means the rate is fixed for the first 5 years. Then it starts adjusting annually. That's the one for the remainder of the loan term, usually up to 30 years total.
Okay, so fixed for a while, then it floats.
Right. After that initial fixed period ends, the interest rate adjusts periodically, typically once a year, like in the 51 example, but sometimes even every 6 months, depending on the specific ARM product. The rate adjusts based on a specific market index, like the SOFR index, plus a margin that the lender adds on. This means your monthly principal and interest payment can go up or down, potentially significantly, after that fixed period ends.
Now, a key point from the source is that the introductory rate on an ARM is usually lower than on a comparable fixed-rate mortgage, isn't it? That's the hook.
Yes, this is the main appeal of an ARM, especially in a higher rate environment like the one we're arguably in now. Lenders offer a lower rate for that initial fixed period, say the first 5 years on a 51 ARM, compared to what they would offer for a full 30-year fixed-rate loan taken out at the same time. The bank rate source provides a really clear example. Comparing a 51 ARM to a 30-year FRM, the initial ARM payment in their scenario was about $2,248, which was notably lower than the FRM payment of $2,489 for the same loan amount.
Okay, so over $200 less per month initially in that example. That difference can mean pretty significant savings in those first few years.
It absolutely can.
That initial saving is definitely tempting, but who is each type of mortgage generally best suited for, according to the bank rate guidance? Let's start with the fixed rate.
Okay, the fixed-rate mortgage is generally considered best for people who plan to stay in their home for a long time, often 10 years or more. They value the stability and predictability of knowing their P&I payment won't change, regardless of what happens with interest rates in the future. It's also often recommended for first-time home buyers just because of its simplicity. It's easier to understand and budget for.
Makes sense.
Also, if you happen to be buying when interest rates are already historically low, locking in that low rate for 30 years can be a really smart long-term move. And one other point, conventional fixed-rate loans typically have lower minimum down payment requirements, down to that 3% we discussed, compared to conventional ARMs, which often require at least 5% down.
Okay, so stability, long-term plans, simplicity, maybe locking in low rates. What about the ARM then? Who might that make sense for?
An ARM can be a good fit for someone who is pretty confident they will either sell the home or refinance the mortgage before that initial fixed-rate period ends. They can benefit from the lower introductory rate for those first few years and basically avoid the risk of the rate adjusting higher later on.
Okay, so shorter-term owners.
Potentially, yes. It might also appeal to borrowers who anticipate their income increasing significantly in the future, which would make potentially higher payments down the road easier to manage if they do keep the loan past the adjustment period. In a market where current rates are high or seem volatile, getting that lower starting rate with an ARM can offer immediate savings and affordability. And borrowers, taking out very large jumbo loans, where even a small difference in the interest rate translates to substantial dollar savings each month, might favor ARMs for the initial lower payments.
So it's really a calculation based on your expected longevity in the home, your future income expectations, and your personal risk tolerance for those potential future payment increases.
Exactly. It's worth noting both types usually offer a 30-year total term. For both, getting the most favorable terms always requires good credit. And importantly, you always have the option to refinance later, whether you started with a fixed or an adjustable rate, assuming market conditions and your own financial situation are favorable when you want to refi.
But the big undeniable elephant in the room with an ARM is the risk, right? The risk of that rate adjustment after the fixed period.
It absolutely is. The Bank Rate Sources FAQ section explicitly states that ARMs are inherently riskier because your monthly payment can increase significantly after the fixed period. The example they give is pretty stark. That initial ARM payment of $2,248 could potentially increase to a maximum payment of $3,376 per month in their specific scenario if rates went way up.
Wow, over $1,000 more per month potentially.
Exactly. That potential for a substantial payment jump is the primary risk you take on with an ARM. It's also worth noting that qualifying for an ARM can sometimes be a bit harder, because lenders often need to assess your ability to afford the potentially higher future payment according to certain stress tests, not just the initial low teaser rate.
So while that introductory rate on an ARM offers some tempting upfront savings, you really need to be comfortable with the uncertainty and the potential for significantly higher payments down the line if you end up staying in the home beyond that initial fixed period. It's a definite trade-off.
It's a classic risk-reward decision, isn't it? Saving money up front with the potential for higher costs later, versus paying a bit more upfront for the absolute certainty of a fixed payment for the long haul. Your personal circumstances, your time horizon in the home, and your view on future interest rates should really drive that choice.
Okay, we've covered a lot of ground. The rates, the Fed's influence, the different loan programs and their detailed requirements, those often surprising closing costs, and now the fixed versus ARM decision. For someone who's maybe internalizing all this and thinking, okay, I think I'm ready to start exploring this seriously, what are some of the practical things they should start gathering now? The Lending Tree source lists some key documents needed for a mortgage application.
Yeah, preparing your documents up front can definitely smooth out the application process later, makes it much less stressful. Obviously, you'll need basic proof of identity, like a driver's license, and your social security number. Beyond that, the core financial documents usually include your pay stubs covering the most recent 30 days and your W-2 forms from the past 2 years.
Okay, pay stubs and W-2s. What if you have other sources of income or substantial assets, like self-employment income or investments?
Yep. Be prepared to provide documentation for any other income. That means 1099 forms if you're a contract worker or self-employed, along with your full personal and business federal tax returns for the past 2 years. If you receive alimony, child support, pension payments, Social Security, or disability income, you'll need the relevant award letters or official documentation showing the amount and duration.
And for assets, bank accounts.
For assets, lenders will want to see bank statements for the most recent 60 days for all accounts, where you hold funds you plan to use for the down payment, closing costs, or those cash reserves we talked about. You should also gather recent statements for any investment accounts like stocks, bonds, mutual funds, or retirement accounts like 401ks or IRAs, as these help demonstrate your overall financial stability and reserves, even if you aren't using them directly for the purchase.
What if part of your down payment is coming as a gift from family?
Good question. If you're receiving a financial gift from a family member or sometimes a close friend to help with the down payment or closing costs, lenders will absolutely require a formal gift letter. This letter needs to clearly state that the money is a gift, not a loan that needs to be repaid, and it should specify the amount, the donor's name, their relationship to you, and usually include their contact information. You'll also likely need to show proof that the funds have actually been transferred from the donor's account into your account before closing.
Okay, got to document those gifts properly.
Right.
And once you've actually found a property you want to buy and have an offer accepted,
then you'll need a fully executed purchase agreement that means signed by both you and the seller. This contract outlines all the terms of the sale, including the purchase price, the property address, the closing date, and any contingencies, like financing or inspection contingencies. This signed contract is essential for the lender to proceed with processing and underwriting your loan specifically for that property. So yeah, gathering these key documents, income proofs, tax returns, bank statements, investment account statements, gift letters if needed, and eventually that purchase agreement will significantly streamline your mortgage application when you're ready to pull the trigger.
That really brings together all the threads we've pulled from these sources today, doesn't it?
It really does. We've taken a pretty deep dive into the current mortgage rate environment, understanding that while we see small weekly fluctuations, the overall expectation based on forecasts and the Fed's current cautious stance is unfortunately for rates to remain somewhat elevated, likely staying somewhere near that 6.8% mark for the rest of 2025. Now, remembering that's primarily influenced by what's happening in the long-term bond market, not directly by the Fed's short-term rate.
And we've explored those different pathways to homeownership offered by conventional FHA, VA, and USDA loans. We detailed their varied requirements around down payment, credit score, DTI ratios, how they calculate income, mortgage insurance or fees, and property usage rules, really showing how different programs are designed to fit different borrower profiles and needs.
And we definitely put a major spotlight on that crucial, often underestimated cost bucket, closing costs. Remembering they typically add another 3% to 6% of the loan amount to your upfront expenses. We explained what those fees cover, everything from appraisals and title work to various forms of mortgage insurance and those prepaid escrow items. And importantly, we highlighted the potential for negotiation there through seller concessions.
Don't forget to ask. Finally, we looked at that fundamental structural choice between a fixed-rate mortgage offering that long-term payment stability and an adjustable-rate mortgage, which can offer potential initial savings but comes with future interest rate risk. We weighed the predictability of the FRM against the uncertainty of the ARM and considered which might be a better fit based on your personal plans and your own comfort level with risk.
Yeah, navigating the current housing and mortgage market is undeniably complex. It requires a lot more than just glancing at the average rate headline in the news. It really demands understanding the underlying economic forces at play, knowing which specific loan program truly aligns with your specific financial situation and your goals, meticulously budgeting for all the associated costs, not just the down payment, and making really informed choices about the loan structure itself.
So what does this all mean for you, the listener? Well, given that the market currently anticipates rates remaining relatively high and maybe somewhat stable for the rest of the year, and considering the sheer complexity and all the costs involved in securing a mortgage that go way beyond just that interest rate number, perhaps the most important takeaway here isn't really about trying to time the market perfectly for some rate dip that may or may not come soon. Instead, maybe it's that the real power in this kind of environment lies in thoroughly understanding your own financial profile, first and foremost. Researching all the different loan options available to you based on that profile, accurately budgeting for all the costs involved, especially those closing costs, and then choosing the loan structure fixed or adjustable that best aligns with your personal long-term plans and your genuine comfort with risk.
To maybe put it another way, in a market where the interest rate itself feels like a significant hurdle, does that prompt you to shift your focus? Maybe move away from just hoping for future rate cuts and instead concentrate on optimizing your own finances now, exploring every single available loan program avenue that might fit you, and really mastering the details of things like closing costs, seller concessions, and loan structure to ensure you get the absolute best possible terms available today.
That's definitely something to seriously consider as you prepare for your own journey into the housing market. Thanks for diving deep with us today.